My name is Farhan. In this video, I'll show you how to prepare the statement of cash flows correctly. This is question number 14, taken from the sample set that is provided by AQA. I'll be linking that question paper in the description, so make sure to check that link. With that being said, let's get started. HQV PLC provided the following information on 30 June 2016. So we're given the statement of financial position for two different years, 2016 and 2015. And all the numbers that you see within this financial statement, they have been standardized in terms of thousands so that it appears to be simple and not messy to read. So we are given different types of assets, we're given different types of equity, we're given two different types of liabilities, and we're also given a set of extra information for the year ending 30 June 2016 that we need to include in our workings. We are required to prepare a statement of cash flows for the year ended 30 June 2016. So what we're going to do is first prepare the ledger account for retained earnings. And the reason being, if you want to start the statement of cash flows, you need to start with the profit from operations. And the profit from operations has some relevance to the retained earnings. We need to prepare the retained earnings ledger account to calculate the net profit or the profit for the year after tax and use the profit for the year after tax as a basis to calculate our profit from operations. So you can see that I have drawn a ledger account for retained earnings and I have shown the opening balance, which is the balance brought down of £3,712 on the credit side of the ledger account. Now, why is this on the credit side? This is an equity account. Retained earnings is part of equity. All equity by default should be credited when it increases. So logically speaking, retained earnings being a part of equity would also have an opening balance on the credit side. And the £3,712 is what I have got from the statement of financial position given here. So you can see retained earnings for the year ending 2016 is 4,332 and retained earnings for the year ending 2015 is 3,712. So whatever balance we had for retained earnings at end of 2015 will now become the opening balance in 2016 and therefore is being used here as an opening balance in the preparation for the ledger account. We're also including the closing balance on the opposite side, which is the balance that we have at 30 June 2016 of 4,332. And anything on the credit side should increase the balance of retained earnings, which is the profit for the year or the final profit after tax or the net profit. This is something that's not given to us directly in the question, and we would have to determine it at the end. So we're going to come back to this. And then on the debit side of the retained earnings account, I've included dividend payments of £1,334. Now, dividends are profits that are paid to shareholders out of the profits that the company makes. So retained earnings and profits, they're part of equity. So anything that reduces the equity should be included in the debit side of the retained earnings account, because anything on the debit side of an equity account reflects a reduction in the balance of that equity account. So that is why on the debit side, we have included dividends paid of £1,334. Now, where did I get this information from? So you will find it in additional information number 6, where it's mentioned dividends paid totaled £1,334,000. We are not including the 3 zeros so that the numbers are standardized and in line with what we have already been given in the statement of financial position to avoid any complications. So once you have used that dividends paid here, then how do you find the balance of net profit? So you add everything on the debit side, which gives us £5,666, which must be the balance on the credit side so that the fundamentals of accounting apply. So what's happening when you subtract the opening balance of £3,712, then you're left with £1,954, which is the profit, in other words, the net profit or final profit or the profit after tax. Now, our requirement when preparing the statement of cash flow is to start with the profit from operations based on the format that's given by IAS 7. Now, profit from operations can be calculated by adding interest expense and the taxation charge for the financial year ending 30 June 2016 back to the net profit. And let me explain you why. So on the right hand side of the screen, you'll see that I'm going to be doing some workings here. Now, profit from operations exclude any finance expenses, which is the interest expense, generally in this case that you will see. And profit from operations is derived by subtracting all other expenses, excluding the finance expenses, from the gross profit that we have. So once you get the profit from operations, then you could subtract the interest expense, and then you could subtract the tax expense, and whatever you're going to be left with afterwards is the net profit, or the profit for the year after tax. Now, because the number here that we found from the retained earnings ledger account relates to net profit, we have to now reverse it using algebra to find the profit of operations. So we start with the net profit, and then we have to add back the interest expense of 402 and tax expense of 512. Now, where did I get these two numbers from? So you will see that the finance charges of £402,000 is what is written here as 402. And then £512 relates to the taxation charges for the year, which is also given here, a provision for taxation of £512,000. Now, a lot of my students I've seen, they have made mistake by selecting taxation paid instead of provision for taxation. So you need to understand the difference between these two. Taxation paid refers to the taxes that have actually been paid for using the cash or the bank balance that the business has. So taxation paid explicitly refers to cash outflow. But cash outflow is not necessarily the total expense for the relevant financial year. The total expense is the provision for taxation of £512,000. The taxation that has been paid here using cash could be relevant to previous years as well. So we do not know this for certain, but we do know for sure that this is referring to a cash outflow, and this is what we should be using in the cash flow statement only, which shows all the cash inflows and outflows of the business. However, in terms of preparing the income statement, we need to know the entire tax expense for the year, which is the provision for taxation of £512,000 in this case. So once you want to find the profit from operations, you start with the net profit of 1954, you add back finance, and then you add back the provision for taxation. You should arrive at profit from operations of £2,868. Now, if you are still confused why I added this here when I'm showing this as subtraction here, I could rewrite this formula by changing the subject, which is something that you should learn in algebra. So I'll just rewrite this so that it makes it easier for you. Now, if you start with net profit and then you add back interest expense and then you add back tax expense, you should get the profit from operations. So it's mainly based on what you start with, and based on how you start your equation, the variables are going to be changed here and there, but I believe you got the idea here. So if you want to convert from net profit to profit from operations, you add back interest expense and tax expenses. And if you want to do the other way around, you could start with profit from operations, and then you subtract the interest expense, and then you subtract the tax expense to arrive at net profit. Okay, so our profit from operations is sorted, which is £2,868 that I've included here. Next, what we're supposed to do is add back any non-cash expense that the business will have. Again, I'm referring to non-cash expense. Why we're adding back non-cash expense? Because a cash flow statement cannot have any expenses that have already been included as part of the profit calculations, which are non-cash. And the best example in this case could be Depreciation could be amortization, which refers to the reduction in value of intangible assets, or it could also refer to any losses that we have made on disposal. So the main two non-cash expenses that are relevant in our case would be depreciation and loss on disposal in this question. So we're going to start with depreciation to begin with. And this thing gets more complicated here because you're in A-level, so it's supposed to get more complicated. Let me walk you through how we can calculate this. So if you check the additional information number 1, it clearly says additional plant was purchased with the cost of £6.6 million. And you can also see in additional information number 2 that equipment was sold for £830,000. This had been depreciated by £485,000. Again, property was revalued, and in the last one, it's given that there were no other disposals or purchases of non-current assets. So the only thing that we have purchased in this case is a plant, and the only thing that we have sold or disposed in this case is an equipment. And the property, which refers to the land that we have, has been revalued. And apart from that, there have been no additions or disposals of any other types of non-current assets during this financial year ending 30 June 2016. So what we're going to do to begin with is check the statement of financial position at 30 June for 2016 and 2015. So you can see that we have property, plant, and equipment categorized under the non-current assets. And property, plant, and equipment, you can see in 2015, the cost was 14,884, but in 2016, the cost is 21,450. So what we're doing first is finding the change in cost of PPE in between these years, and that is £6,566. Next, I want to show you how we can prepare the T account for property, plant, and equipment at cost. Now, remember that property, plant, and equipment is a non-current asset account. And obviously, all assets should have an opening balance on the debit side. Again, within a ledger account, we understand that the left-hand side is the debit side and the right-hand side is the credit side. So all assets should have an opening balance on the debit side. So that is why on the debit side, we're including balance brought down of £14,884. Where did we get this from? So this is the closing balance from 2015, which should obviously end up becoming the opening balance in 2016. So that is what we have included here, balance brought down of 14,884. And then we have included the closing balance of 21,450 based on what we have at end of 30 June 2016. So once you have both the opening balance and closing balance here, what I'm doing next is on the debit side, adding an additional 6,600. Now, where did this come from? If you check the additional information number 1, it says that additional plant was purchased with the cost of 6.6 million. So 6.6 million. So I have to standardize this number by removing 3 zeros based on how everything has been done so far. So 6600. So we could standardize it into 6600. So additional plant being purchased refers to an increase in the value of assets that we already hold for property, plant, and equipment at cost, which means if assets are going up in this case, we have to debit it. And that is what we are doing here on the debit side. So we have included bank of 6,600, which refers to the fact that we have purchased an additional plant. And then we're also including revaluation reserve of £1,830 on the debit side of the property, plant, and equipment account. Where did I get this amount from, and how does this relate to the entire context that we're solving? So if you remember point number 3, what does it say? It says that a property was revalued, okay? And this property being revalued, where could I find necessary numbers relevant to this revaluation? The balance sheet. Now, if you check the balance sheet properly, you will see that under this section for equity, revaluation reserve has been included, which relates to the land or the property we are talking about. And you will see that this has a balance of 1830 for 2016. But if you check 2015, there was nothing, which means in 2015, there was really nothing regarding revaluation reserve, but in 2016, at end of 2016, the amount is £1,830, which is tied to the property being revalued that is mentioned in additional information tree. And why are we including this in the debit side of the property account though? Because property, plant and equipment is an asset account. So any revaluation is going to increase the value of assets at the same time. So if you were to journalize this, you would be debiting property, plant and equipment at cost by 1830, and you would be crediting revaluation reserve, which is an equity account, by 1830. So that is why in this case, within the ledger account for property, plant and equipment at cost, on the debit side, I'm showing an additional increment in the value of assets held in the business where it's stored in the revaluation reserve, and that is £1,830. Then this amount regarding disposal, this relates to the disposal of the equipment, which is what we are seeking to find by solving this ledger account for property, plant and equipment. So how do we balance this? So we add everything on the heaviest side, which is the debit side, and that is £23,314, which must be the balance on the credit side as well. And since we already know the closing balance here, we subtract that from 23,314, and you're going to be left with £1,864, which refers to disposal of the asset. And the asset in this case is the equipment that we know from additional information number 2. So this means if I was to interpret this value here, this simply refers to original costs of equipment that was sold was £1,864. In other words, the equipment that we have sold had an original cost of £1,864. So it obviously should have 3 more zeros, which should make it 1.864 million, but we're just going to keep it simple and say 1,864. Okay. Now, what I'm going to do next is find the net book value for this equipment that we have sold. Now, we understand from our calculations that the original cost of the equipment that we have found from the ledger account is 1.86 million or 1,864. And if I want to find the net book value, I take the original cost and subtract the total depreciation. Now, where did I get 485? So if you check the additional information number 2, you will see that equipment was sold for 830,000, which refers to the disposal proceeds, and the total depreciation is 485,000 pounds, which is what we have included here as a standardized number. So we subtract the total depreciation from the original cost, and you get 1,379 pounds as the net book value for the equipment. So once you have that, then given that we know the disposal proceeds is 830,000, which is technically 830, you can see that our equipment had a net book value of 1,379 before disposal, but we ended up selling it for less at 830, which means that we have made a loss on disposal, and the loss can simply be calculated by finding the difference between the disposal proceeds and the net book value, which gives £549 as the loss on disposal. So we have loss and disposal as a non-cash expense. Why? Because you are receiving 830 by selling the equipment as cash or money that's going into your bank account. But the fact that you have sold this for a lesser amount, you are not really having any cash involvement. The fact that you have a loss on disposal doesn't really reduce the value of your cash, but rather it increases your expense, and you could write off that expense when you prepare your income statement. So that is what the loss on disposal of £549 in this case is a non-cash expense. And because it's a non-cash expense, we have to add it back in the cash flow statement to our profit. So that is why you can see profit from operations, add back depreciation, and then add back loss and disposal. This should have been included here, but when I was preparing this, I remembered this later. So that's why. So it doesn't really make any huge difference. So what about the depreciation of £1,217? So that is something I will show you now. So you can see that depreciation amount is included here, simply given in the last few lines, where depreciation charges of £1,270,000 have been included in the income statement. So which is obviously a non-cash expense. And that is what we have included here in as 1217, very simply. Next, we have to look into each of the current assets and each of the current liabilities that we have been given in the statement of financial position. And we need to find the change in between the two financial years ending 30 June 2015 and 30 June 2016. And based on whether or not a current asset or a current liability has increased or decreased, we're going to be taking different steps which involve subtracting or adding them accordingly. But I have a shortcut to how you can do this rationally and with logic. First of all, let's start with inventories, which is the first current asset that you will see here. So we have inventories, and you can see, just do a glance, and you will see that in 2015 it was 805, but in 2016 it's 779. So which obviously refers to the fact that there has been some form of reduction. And the reduction, if you find the difference between the 2 years, is 26. So that's why we have written here, decrease in inventories by 26. Now, why am I adding this? So you could memorize this format, obviously, but you would still not really understand like how this adds up, and you're not really learning accounting for fun or passion, but just to get by, which I don't recommend, because you should put your passion and heart into it. So why are we adding this here? Decrease in inventories of £26. Because if there's a reduction in inventories, think about it like this. Compared to last financial year, in this financial year, we have spent £26 less. So if you have spent £26 less, what does that refer to? That refers to you having more cash. And that is why we are adding this in this case. Okay? So let's look into the next current asset that we have, which is trade and other receivables. Now, trade and other receivables refer to the credit customers of the business. And the credit customers of the business are those people to whom the business has sold goods on credit, and these customers have made a promise to repay whatever they owe on those credit sales at some point in the future, some point in time in the future. Okay. Now, if you check the trend for trade and other receivables, you'll see in 2015 it was 214, but in 2016 it's 311. So what we can see that in between the two financial years, there has been an increase, and the increase is the difference between 311 and 214, which is 97. Now, why are we subtracting this here though? So increase in trade receivables. Think about it. If your credit customers to whom you have made sale on credit have gone up, that means that you have got less cash coming from these credit customers, right? So if you've got less cash coming to your business from these credit customers, that should reduce the balance of cash that you should have in your business. And therefore, that is why we are subtracting it. Again, if you want, you can just memorize it, where any decrease in current assets, you're going to add it, and any increase in current assets, you're going to subtract it. But I would always recommend to apply some form of logic and rational judgment behind why we are doing this, because the whole world depends on this accounting. Okay, next. So we have two types of current assets. We don't care about cash and cash equivalents. So the cash and cash equivalents are mainly there for you to check if your math is 100% correct, and which is something you will see that we'll do at the end. But now let's focus on current liabilities. So if you check trade and other payables, which is the first current liability, you will see trade and other payables in 2015 was 652, but in 2016 it's 345. Now, who are the trade and other payables? Now, the trade and other payables are also known as the credit suppliers of the business. The credit suppliers of the business are a financial obligation to the business, which means if the balance for trade and other payables have decreased since 2015 from 652 to 345, as you can see here, then that means we have paid these credit suppliers. So if we have paid these credit suppliers, we're going to pay them using cash. And if we have paid them using cash, then obviously that should result in a reduction in the available of cash that we have in the business. And therefore, we have to subtract it. So that is why, check the cash flow statement now. So we understand that there has been a decrease in trade payables, which is TP, what I've written in this case in short. And that is £307 shown within brackets, which refers to a cash outflow. Think about it. We have paid our suppliers. We have paid for our financial obligations. So if we have paid our financial obligations, that results in a reduction in the cash available in the business, and therefore is a cash outflow and is being subtracted here. Okay, so we have already discussed the loss and disposal. So you will see that we have another current liability for taxes. So let me show you the treatment in this case. Now, if your tax payable goes up in between the years, as you can see in this case, so you have a new liability of 557 and an old liability of 443. This is more of a long-term perspective that we see, although it's not classified under current liabilities. But in most cases, when you go to university and you will see accounting there, you will see that taxes are treated more of on a non-current basis, because when you do business for companies, those companies make hundreds of millions of dollars or hundreds of millions of pounds that they would be paying taxes in a deferred way. However, that's not important at the moment, but because we're preparing a cash flow statement, previously, we had a discussion where we talked about taxation paid explicitly refers to cash outflow or cash payment made for tax purposes, which is what is given here in information number 5. So taxation paid is real cash outflow. So if it is real cash outflow, this is the amount that we need to include in our statement of cash flow preparation. We also understand tax expense or provision for taxes refers to the tax expense that needs to go into the income statement, which is also what you can see is given in the very last line of the question. So this refers to an expense, £512,000, but the taxation paid total £398,000 explicitly refers to tax paid for in cash. That is what we have to include in our statement of cash flows, not the tax expense or tax liabilities or any other stuff. So what we have done here, so tax paid of £398, and then I've included interest paid of 402, which is the finance charges of £402,000 that's given here. Now, how do I know that this interest has been paid? If the interest wasn't paid, there would be another current liability that you will see here, which says interest payable. Since that is not mentioned here, we can confidently assume that this interest that's mentioned here of £402,000 has been paid for in cash, and therefore is shown as a negative number referring to a cash outflow. So you can find the subtotals before the tax and interest lines, so which is the cash from operating activities, and from there you subtract the tax paid and the interest paid. And then you get net cash from operating activities, which is £3,456. So normally you would see that the wording changes here. So in this case, we are writing from because we have a surplus or an inflow or an excess or a positive number, which is 3,456. If it was a negative, it would be worded differently, which you would see eventually in the next section. Now, after the operating activities section have been done, then we start with investing activities. And always remember, just to be very simple, whatever goes into the investing section within the cash flow statement either has to do with purchasing a non-current asset or selling and disposing a non-current asset. So we have some information that's given straightforward to us in the question. So if you check additional information number 1, what does it say? Additional plant was purchased with the cost of £6.6 million. So 6600, the amount that we have here refers to a cash outflow, and this is investing. Why is this an investing activity? Because the plant that we are purchasing refers to purchase of a non-current asset, and like I've mentioned before, always remember, investing activities only includes any purchase of non-current assets and any disposal of non-current assets. So purchase of non-current assets in this case is 6600 shown as negative, referring to a cash outflow. Then we are including the proceeds from sale of equipment, which is 830 shown as a positive number here. Why? Because if you're selling the equipment based on additional information number 2, you are selling it for £830,000, which refers to a cash inflow. This is the money you are getting by disposing this equipment. So this refers to a cash inflow and therefore is added here under the investment section. So once you have this two information, like I've said before, either you're purchasing an asset or you're selling an asset. So the difference we have is a negative £5,770 for investing activities. And you can see the wording has changed. Instead of from, which refers to a surplus, we are now using used in investing activities, which talks about more cash being drawn out for the specific activity rather than cash that has come in. Okay, then the last thing to worry about the cash flow statement is the financing activities. All right, now just to make it very easy and simple for you, financing activities will only refer to new issuance of shares, or it could refer to getting new debt or paying off an existing debt. Also, it could refer to you paying dividends. Okay, so we're going to start with dividends. So financing activities relate to equity and non-current liabilities, okay? Not current liabilities. Current liabilities are what we have included in the operating section, as you have seen before. For example, we had trade payables, we had taxes and all those things. Okay, now for the financing activities section, we only talk about equity and non-current liabilities. So we are going to start with dividends. Dividends paid of 1,334, and that is in negative. So where did I get this information from? If you remember, when we prepared the retained earnings account, we got the information for dividends from point number 6, which explicitly mentions the words paid, and that refers to a cash outflow, and the amount in this case is £1,334,000, which can be standardized as 1334. So that is what we have included here under the financing activities section to begin with as a negative number. Then I have written proceeds from debt of £350. So proceeds from debt obviously refers to cash inflow, more cash coming in from debt. How do I know it's 350? So let's go to the statement of financial position, and you will see that debt simply refers to the non-current liabilities that we have. And in this case, it is the 8% debentures. So another thing you can see is that 2024 here refers to the year that you would be paying this debt. And because this question refers to a financial position statement being prepared at 30 June 2016, from this point in time, 2016 until 2024, it's a long year ahead. So that's why we call this a non-current liabilities. However, you will see that at end of 2015, the balance for this debt, which is the debentures, was £1,750, but at end of 2016 is £2,100, which means during these 2 financial years, debt has gone up, and the amount that it has gone up by is £350. Now, if debt has gone up, this refers to more cash coming into the business, which the business can use for investment purposes or utilizing in its operations. That doesn't matter, but it's cash coming into the business essentially, which refers to cash inflow and is therefore added under the financing section as proceeds from debt of 350. So the 300 was calculated by finding the difference between 2,100 and 1,750. Then we have receipts from share capital, and that is 3150. So receipts from share capital refers to additional share capital being issued to the public, and that's a way of raising money. So how does this work in the real world? So it's the same thing, like you could invest in a company, you could buy a share in that company. And when you want to buy a share in that company, you are essentially investing in this company, even though let's just say you're paying $100. So that money is being used in the company's operations. So from the company's perspective, the money that you're giving to them as a shareholder is a receipt, is a cash coming in, and that is why we're adding it here. But where do we get £3,150 from? So let's check the statement of financial position, the equity section, and you will see that we have share premium and then we have ordinary share. The ordinary shares refer to the share capital that was issued initially. Share premium refers to additional issuance of shares, but mainly done to existing shareholders. For example, you had invested money when this company started initially. And let's say after 5 years, because you are an existing shareholder, you also had the opportunity again to invest in this company again through a way which is known as share premium. So both of this refers to issuance of new share capital. So you will see the difference between the ordinary shares from 2015 and 16 is plus 2100, from 4200 to 6300. And for share premium, this has also gone up, which is the difference between 2170 and 1120, which is 1050. So you add these two together and you should get 3150 as the increase in share capital or as a whole. So 3150 is what we have included here. And we do not have really any other activities for financing to take care of from the equity section, but I believe you may still have a confusion with regards to the revaluation reserve. Now, retained earnings and revaluation reserve. So retained earnings have already been incorporated because that was used to find the profit from operations, which goes at the very beginning of the cash flow statement. What about the revaluation reserve? Now, revaluation reserve is not really exactly cash. Think about it. A land goes up in value. A property goes up in value by £1,830. It's not really cash. It's just valuation done based on existing market conditions. So unless you sell it, you're not really getting any cash. So that is why we can't really include revaluation reserve as part of the financing activity in this case, because it doesn't meet the definition of a cash inflow. So once you get all the totals for the financing activities, that should be 2,166, which is positive, and you will see the wording has changed to net cash from financing activities. Then what we have to do next is add the total for operating with the total for investing and the total for financing, and you should get negative 148 with reference to a decrease in the balance for cash from 2015 to 2016. Now, the opening balance of £87 is what I'm adding here. So where did I get this from? So this opening balance of £87 should be the closing balance from 30 June 2015. So if you check the statement of financial position, you will see that at 30 June 2015, cash and cash equivalents had a balance of £87, which definitely should be the opening balance when it goes to 1 July 2016. So that is what we have done here. So you're adding 87 to the net decrease in cash of 148, and what you end up with is a negative balance of 61 for cash and cash equivalents, which is also known as the closing balance at 30 June 2016. And that is negative 61. So negative 61 here refers to a bank overdraft. In other words, the business does not have enough money available in the bank account. Rather, it has a negative amount, a deficit of 61. And if the business has a deficit in this case, this is what we classify as a current liability. If this is a current liability, you can clearly find it in the statement of financial position, where you will see that we have cash and cash equivalency, which is also known as bank overdraft, and that is 61 here, explicitly mentioned on the current liabilities, which also refers to the negative balance or the cash outflow or bank overdraft or current liability, whatever you want to call it, of £61 as the closing balance at 30 June 2016. That's all for the statement of cash flow preparation. You can check the links in the description if you want to book a last-minute tutoring call. With that being said, good luck for your exam.